Today, we're doing a deep dive, a real forensic analysis of the DoD's SkillBridge program. Now, on the surface, it's this amazing launchpad for service members heading into the civilian world. But, as we're about to see, it can also be a minefield of pretty complex financial and regulatory risks. Let's peel back the layers and uncover what's really going on.
You know, the whole idea behind SkillBridge is just fantastic. It gives service members a real running start at their next career, all while they're still technically on active duty. But the question is, does this well-intentioned bridge have some hidden structural flaws? Is it a regulatory trap that can snag even the most careful transitioning vet?
So here's how we're going to break this down. First, we'll look at the promise of SkillBridge, what it's supposed to be. Then, we'll get right into a major contradiction between DoD rules and the IRS. After that, we'll unpack something called the Imputed Income Trap, dig into the risks with BAH and state taxes, and finally, we'll give you a roadmap for how to navigate this whole minefield.
Okay, let's start with the basics. What is SkillBridge actually designed to do? The whole thing is governed by one key document, Department of Defense Instruction 1322.29.
The concept here is really simple, but it's also incredibly powerful. For your last 6 months in uniform, you can basically embed with a civilian company. You're learning a new industry, getting your foot in the door, all while you're still getting your full military pay and benefits. I mean, it's meant to be the ultimate transition tool.
When you look at the ground rules, a couple of things really jump out. First, a field-grade commander, an 05 or above, has to sign off on it. And, this is crucial, that commander can pull you back at any time if the mission requires it. The big takeaway here is that SkillBridge is a privilege, it's not a right. You are still, first and foremost, an active-duty military asset. And right here, this is where we hit the central problem. It's this grinding collision between military policy and federal tax law. This is the very heart of the SkillBridge trap.
Just look at this. On one side, you've got the DoD Instruction 1322.29, and it could not be more clear. You are strictly ineligible for any financial compensation. But then on the other side, you have the IRS, and under Section 61A of the Internal Revenue Code, their definition of income is basically everything, all income from whatever source derived. So the DoD says absolutely not, and the IRS says absolutely everything. And that's where things get really dangerous.
So let's put a formal definition on this. The SkillBridge trap isn't just one thing. It's this chaotic pileup where three completely different sets of laws slam into each other. You've got military personnel policy, federal tax code, and state residency laws all converging on a single service member who's just trying to do the right thing.
This huge contradiction leads us straight to the first part of the trap, and it's a concept called imputed income. This is how a company's generosity, things that feel free, can end up creating a surprise tax bill.
Imputed income might sound like some fancy accountant term, but the idea is simple. If a company gives you a benefit that isn't cash, think free housing, a company car, maybe they pay for your moving expenses, the IRS says, okay, what's that worth in cash? That cash value, the fair market value, gets added to your taxable income for the year. So you never saw a dime, but you're being taxed as if you did.
And listen, this isn't some theoretical what-if scenario. This is the smoking gun. This quote is pulled directly from a real Siemens SkillBridge job posting. They spell it out in plain English. The housing they give you is a taxable benefit, and it's going to show up as imputed income on your W-2. The companies, they know it's taxable.
Let's put some real numbers on this to see how painful it can be. Let's say that corporate housing is worth $12,000 for the internship period. You never touch that money, right? The company pays the landlord directly. But come tax time, your taxable income is now $12,000 higher, which could create a tax bill of over $3,700, a bill you have to pay out of pocket from your military paycheck. That's phantom income. It's a tax on money you never actually held.
Now, the first thing people ask is, well, couldn't they just call it a gift? That's a fair question, but the Supreme Court shot that idea down way back in 1960. In a case called Commissioner v. Duberstein, they ruled that if a company gives you something for a business purpose, and let's be honest, recruiting you is a business purpose, it's not a gift, it's compensation. End of story.
So that imputed income trap is bad enough on its own, but it's not the only problem. Things get even more complicated when we start talking about your basic allowance for housing, your BHA, and how state tax laws get tangled up in all of this. The most important thing to get straight here is the difference between government money and corporate money. Your BAH is what's called a qualified military benefit under Section 134 of the Internal Revenue Code. That means it is 100% tax-free. But a housing stipend from a company, that falls under Section 61, compensation for services, and it's 100% taxable. Same purpose, a roof over your head, but a totally different tax result.
And this creates a weird system of winners and losers, what you could call geographic arbitrage. See, your BAH rate is tied to your last duty station, not where you're doing your internship. So you get the loser scenario. You're coming from a low BAH place like Fort Cavazos and interning in super expensive San Francisco. Your BAH won't even come close to covering the rent. But then there's the winner scenario. You're coming from high BAH San Diego to a cheap place like Huntsville, Alabama. You could actually pocket the difference, completely tax-free.
And then you've got state taxes. This is a huge gotcha. A lot of service members think the Service Members Civil Relief Act, the SCRA, is this magic shield that protects all their income. It's not. The SCRA protects your military pay. It offers zero protection for any income you get from a civilian source, like that housing stipend from a company. The state where you're doing that internship, they can and they absolutely will tax that income.
Now, this right here might be the most dangerous trap of all, because you can fall into it completely by accident. It's called changing your domicile. Let's say your legal residence is in a no-income tax state, like Texas, but you go do your SkillBridge in a high-tax state, like California. And while you're there, you do something that signals intent to stay, like registering your car or registering to vote. California can make a case that you've changed your legal residence, and if they succeed, that SCRA protection on your military pay, it just evaporates. And suddenly, your entire military salary could be subject to California state income tax.
Okay, we've laid out all the dangers. It's a lot, I know. So the big question is, how do you get through this minefield safely? This next part is a framework for leaders, for JAGs, for anyone who's advising a service member on this process.
This chart really tells the whole story. Look at the top. Your military pay and allowances? All good, totally compliant. But look at that bottom half. Corporate wages, cash stipends, even housing provided by the company. Not only are they taxable under the IRS code, they are a direct violation of the DoD instruction that says no financial compensation. So, by accepting these things, a service member is not only creating a tax problem, they are out of compliance with military regulations.
This is another absolutely critical point of confusion that has to be cleared up. SkillBridge is a duty status. It's called an administrative absence. You are not on leave, which means civilian wages are strictly forbidden. Terminal leave, on the other hand, is chargeable leave. You're in your final countdown to separation, and during that specific window, Congress has explicitly said it's okay for you to get a civilian job and get paid. Mixing these two up is a massive, massive compliance failure. So, if you're an advisor, here is your 5-point checklist to keep your people safe. 1. Go over every single offer with a fine-tooth comb and look for anything that even smells like compensation. 2. Make it crystal clear that corporate benefits are taxable income. They are not gifts. 3. Hammer home the difference between being on SkillBridge and being on terminal leave. 4. Make a plan for that state tax hit on the civilian income. And 5, and this is the key tactical move, advise the service member to tell the company's HR department to put a hard stop on all payroll until the exact day their terminal leave begins.
And all of this brings us to one final big question. SkillBridge is a great, vital program, but this trap we've just walked through is very real and it's systemic. So whose job is it to fix it? Does the DoD need to rewrite its regulations to reflect how the world actually works? Should corporations stop offering these kinds of benefits that put service members in a legal and financial bind? Or, in the end, does the burden just fall on the individual service member to somehow navigate this incredibly complex and dangerous landscape all on their own? That's the real policy question we're left with.